Wall Street cash warning. Every headline across global financial media seems to be shouting the exact same message right now: a massive market crash is inevitable. When the head of America's largest commercial bank publicly states he wouldn't buy stocks or long-term government bonds at current valuations, the financial community naturally takes notice. At the same time, legendary holding companies are sitting on historic cash piles reaching hundreds of billions of dollars, having been net sellers of equities for over 3 consecutive years. Across the United States, Europe, the UK, and Asia, retail investors are caught in a classic psychological trap. On one side, financial media tells you that an economic collapse is right around the corner. On the other, tech indexes continue pushing near all-time highs, driven by massive corporate capital expenditures in artificial intelligence, automation, and industrial infrastructure. So what is actually happening beneath the surface? Are we living through a historic, central bank-fueled market bubble set to pop in late 2026? Or is this simply another wave of noise designed to keep retail capital frozen on the sidelines while institutional money executes long-term asset allocation? Today, we are examining the data, filtering out the media hype, and quantifying actual risks across global markets. Crucially, we will break down an actionable operational framework, showing you exactly where capital should move across core index ETFs like VOO, FCHD, and VXUS, and how to position your cash reserves right now. 2. Examining the macro risks, debt, inflation, and valuations. To evaluate the validity of current crash warnings, we must first break down the primary structural risks confronting the global economy. First, sovereign debt has reached levels unprecedented in peacetime. Sovereign nations across the developed world are spending significantly more than they generate in revenue, refinancing massive debt stacks at sustained, elevated interest rates. This structural deficit forces long-term bond yields higher, raising the baseline cost of capital for corporations, home buyers, and small businesses alike. When risk-free yields remain attractive, high-priced equities face intense valuation friction. Second, geopolitical friction and trade reshoring continue to inject cost pressure back into global supply chains. When tariffs or trade barriers are introduced, corporations rarely absorb those expenses, they pass them directly down to end consumers. This dynamic creates persistent, sticky inflation that prevents central banks from rapidly slashing interest rates to rescue asset prices. Third, equity valuations, particularly within the S&P 500, are historically rich. By metrics like the Shiller-Cape ratio, current market multiples leave virtually no margin of safety for operational hiccups, earnings misses, or supply chain disruptions. When stocks are priced for perfection, even routine quarter-over-quarter earnings stumbles can trigger sharp 10% to 15% valuation drawdowns. 3. The truth filter, distinguishing panic from fundamentals. Now let's apply a strict truth filter to these warnings. It is essential to separate sensational retail commentary from empirical financial mechanics.